Hey everyone, happy Wednesday. Another edition of #askrobco with James Wild and our special guest from our friends at Lonres, Marcus Dixon. Marcus, how are you doing?
Good, very good. Thanks, Rob. Thanks for having me along.
Welcome back. Just going to go straight into European Super League. James, any views on that? It's the subject matter of the week so far. You being a Manchester United fan, me being an Arsenal fan. What are your thoughts?
Well, since Sunday, when the news was initially breaking and filtering through, it seems now to have been, put on hold indefinitely. I'm sure some rumours might still come through. It might resurface in a couple of years' time. But thankfully, it seems to be all the British clubs seem to have exited now, with just a couple of the European clubs remaining. But I'm sure those plans will be completely halted.
It looks that way. Probably Arsenal's best chance of qualifying for the Champions League out the window for another season. Right, let's get back to more important matters. As everyone knows, we are here every week to provide you with an update of what's going on in the property market: lending, sales, credit, sanction, risk, residential, commercial, alternative. We are here to tell you everything that's happening, and we will start off, as we always do, with our sales intel update. That's handout 1 on the right-hand side. If you open that document, you will see the latest set of numbers that are running through the system. Monday, 12th of April, week commencing, week 15, 2021. New instruction numbers, very consistent, apart from that 1 week during the Easter holidays where numbers were down in the late 300s, and that's been very consistent over the last month or two. So very good numbers there. And with the sold figures that have come through, we have seen a slight increase on the last few weeks, but nothing great. So no way near the sales figures that we achieved previously at the beginning of the year or the back end of last year. So I think that's probably where we'll start the conversation. James, new instructions, sold figures coming through, the trends that we've been seeing. What's your view on that?
Thank you, Rob. Well, as we were commentating, as the market is starting to reopen, we did anticipate those new instruction levels to increase, which they have done for the last couple of weeks. We've had 2 weeks at 286 new instructions, which again, positive. It just brings more stock to the market to facilitate and enable those higher sold numbers. As we've said, there is likely to be, obviously, if the average sale period at the moment is 1 to 2 months, we're seeing those transactions taking another further 1 to 2 months to complete. So there is likely to be some lag off these increased new instructions. But overall, I believe it brings more positive sentiment to the London property market.
Yeah, Marcus, what's your view on that and the very live data and intel being provided in those current trends?
Yeah, I mean, I agree with James, but I think it's one of the interesting things that's happening at the moment, and I'm talking about this with quite a lot of people, is we're in sort of a pretty unique position where we normally see at the end of a stamp duty holiday, or when there's a change to stamp duty, that we see a rapid increase in the number of exchanges, because obviously people want to get in before the date that everything changes, which up until the beginning of March was the 31st of March. So we saw a rapid increase in activity, and then we were expecting to see things drop off a bit, which we definitely did in the first couple of weeks of April. But interestingly, a situation that we've rarely been in before was that the stamp duty holiday was extended again until June. So we're in a sort of a unique position in terms of, we had a race to the end of March, which actually a lot of people were already on that timeline and didn't change that. But suddenly we've also got this new situation where there's now a new deadline, which potentially, actually, if people sort of worked pretty hard and found something quickly, they could hit. So we've seen this sort of strange situation where the market raced to the end of March, but actually we saw in March, because of the announcement at the beginning of the month of the extension, a lot more stock being listed, and so we're now in the sort of race to the end of June. So it's a really interesting market, and but I wouldn't be too worried about a bit of a lull in sort of exchanges over the first couple of weeks of April, because it's something that we were always expecting with the 31st of March deadline.
Yeah, absolutely, and I think I repeat this every week. I feel that as valuers in the supply or distribution chain within the industry, we are a live barometer of activity, and we are getting busier each week. And now we're a week or two after Easter, and we're already seeing numbers and instructions grow on a daily basis. And probably that's as good a feed as you're going to get over and beyond the instructions that are coming on stream, because instructions coming on stream move very quickly to agreed and under offers that move very quickly to valuations, survey, etc. So I think that is a testament to itself, and that's one of the key indicators that we always go on being a key supplier or key part of that distribution chain. James, what else from numbers?
Well, just going back to our weekly sales figures and that transaction data, we obviously noticed we had a bit of an upturn this week in the sales data as we've reported. The 2 weeks prior did see quite a significant drop off, and I just wanted to talk to Marcus a little bit more about some of his sort of rationale for that. I mean, the government did announce the stamp duty extension relatively at the 11th hour, sort of very late in the day. And as we mentioned before, those periods it takes to move from agreeing a property purchase to transacting on it is in the region of 2 months. And whether that feeds into your rationale at all, Marcus, for those 2 weeks we saw with a significant dip in the sales numbers.
Yeah, no, definitely. I mean, I think that the announcement, I think the budget was on the 3rd of March, and so it gave people less than a month. If they would have been planning to complete in March, I would imagine, and probably early March, to make sure that there was no complications that meant they didn't make that stamp duty saving. Also, we had a sort of a triple whammy of the deadline on the 31st of March, so people would have been completing before. We had Easter, which obviously also, a lot of people, it shortens the number of working days that you can transact, and it's. Do you really want to be looking to complete on the Thursday before a 4-day bank holiday weekend? Probably not. So I think a lot of those things, plus obviously the opening up of various retail, leisure facilities as well. I think a lot of those deals that we would have normally expected in the first couple of weeks did happen in March. Just to give you an idea, I ran some figures for first half of April, and the number of exchanges we had. I'm not doing too many comparisons with 2020 because obviously we're into sort of the lockdown period a year ago, so everything goes a little strange. But if you look at the previous 5 years, so 2015 to 2019 averages, we had about 8%. We were about 8% down in terms of exchanges in the first half of April, but 37% up in terms of under offers. So I think the lull in activity is because of what happened, because of everything being shifted forward. But actually, once the announcements came through at the beginning of March, it spurred more people on to put things under offer, and that chimes with what you're saying, Rob, in terms of levels of activity on the valuation side increasing as those properties sort of move through the system.
Yeah. I mean, ultimately, for us to return to the kind of volume we did see in the back end of 2020, we need to be seeing 500-600 new instructions a week. And, we're probably trading about 30, 40, 50% below that currently. That number has to increase quite dramatically for them to be converted into actual sales. And I suppose the anticipation is whether we are going to see that in the coming weeks and coming months, because ultimately you're not selling more properties unless those properties are brought to market. And I think that is the key indicator. And yes, we're hovering in the late 300s and have been there for a few weeks. But let's be really clear, in August, September, July, October last year, we were at 500, 600, even 700, so double the amount of instructions coming on stream. So we're really going to have to see that number increase over the coming weeks and months for the year to have the similar or high levels of sales volumes that we've had previously.
Yeah. And Marcus, as you said there, we had the budget obviously on the 3rd of March, which there was some forecasting, some prediction that stamp duty holiday would be extended. But I think until that was formally announced, a lot of buyers would have been holding off. So that poses the question, could June prove to be a very busy month in terms of those sales figures, with buyers then following on and getting the momentum off that stamp duty holiday?
I believe so. I think that it certainly helped with the March figures, and interestingly, the first quarter of 2021 was the busiest first quarter since 2016. And if you remember back to 2016, the end of that quarter was the introduction of the additional rate, the additional 3% stamp duty rate. So it is something that we tend to see, and the fact that it's been extended until June, I mean, obviously, it is a point of announcement. It was only a 4-month extension, so people, need to get their skates on if they want to get a deal through by then. But I think for us, in terms of activity in the second quarter, I think that it can only increase the levels of activity. Whether we'll see the highs that we saw in March, I'm not quite sure, because I think quite a lot of people have been working towards that March deadline for about 6 months at least. So, but I think I'm expecting a busy spring market, partly down to stamp duty, and then I'd imagine a relatively slow summer. The tapered extension until September, whilst obviously gives a little bit of flexibility, actually the savings are quite a lot smaller. So I think that's going to have much less of an impact than that June date, and I think a lot of people are going to be sort of racing for that date now. So the valuers and conveyancers, I imagine, are going to be pretty busy over the next few months, sort of trying to get everything through in time for that new deadline.
On that point, Marcus, you've kindly given us some data of activity in quarter one that you've broken down from Lonres. So if everyone wants to go to handout number 2 on the right-hand side, and maybe you can talk us through this data of activity in Q1 2021 from your intel.
Yeah, so what I've looked at here is looking at the level of transactions that we saw across different price brackets in prime London. So this just breaks it down. So from on the left-hand side, you've got the under $1 million market, and then up to the sort of super prime 10 million plus market on the other end. We'd always expected that the first quarter under $1 million was going to be particularly busy. Obviously, the big stamp duty savings are up to £500,000, and so in the lower price brackets, the saving makes up for a higher proportion of both your buying costs and the total purchase cost. The £15,000 saving on a £10 million house is obviously is welcome to everyone, but it's not going to be the big decision maker in terms of whether you buy that house or not. Whereas actually at 600,000, 700,000, 800,000, it possibly is. But what was also interesting is we saw activity increase across all other price bands in the first quarter. So the pink, the bars, I think you might have slightly coloured me, but the bars on the left-hand side look at the annual change. So that's a change compared with 2020. But I've also compared with the previous 5 years, the average over the previous 5 years, just to get rid of any fluctuations due to the fact that obviously the end of March got a little bit strange last year in terms of statistics. But I think what's really encouraging is that we've seen activity across all markets, not just the sub 1 million market, and actually the top end. And this is a trend that we were seeing in the last couple of quarters of last year. The top end of the market is very busy. I think that one of the interesting things about lockdown and the pandemic is that it has really made people think about where they live, where they want to live, and what they want to own. And that's not just that's across all price brackets. And the interesting thing is that people who have much bigger budgets, so who are spending 10 million, 20 million or more, are also thinking exactly the same way that we've always wanted a house on that particular square, so we've gone and bought it. And so we've seen the level of activity of that 10 million plus market increase by annually by 62%, and compared with the long run average by 50%. So pretty significant increase. I mean, volumes are pretty small, but
I think that's a really important point. And obviously we're prime, super prime specialists, so we definitely see an uptake in activity of valuation work in that area. I think what's really important to share, and I suppose stress with everyone, is that there is a food cycle, food chain within the property market. And what happens is when you have stamp duty holidays and incentives and low debt interest rates and great mortgage products at the very bottom, it then feeds through to every other bracket that allows everyone to upsize, because affordability or opportunity to buy is enabled because they can get out of their property at a good price that allows them to buy something else. So I don't think we should devalue or underestimate the importance within that redistribution or food chain within the property industry of how important what is happening at the bottom that finally ends up leading to the very top.
Yeah, no, I'd agree. And I think that what has become very clear over the last 12 months is that the government is very committed to a functioning and successful housing market. And, at the bottom end, that's been through, stamp duty incentives and obviously new incentives for mortgages for first-time buyers. But actually, whilst the stamp duty savings, don't make as big a bigger sort of change to the sort of overall cost at the upper end, that confidence and that reassurance that the government is supporting the housing market has got to be a good thing, whether you're spending, £150,000 or 15 million. I think the sort of the feeling and the sentiment towards the market is pretty similar.
Yeah. And Marcus, just following on from your graph there, Q1 super primes obviously started off 2021 very positive. It follows a fairly groundbreaking year in 2020 where we saw record-breaking transaction volumes of those 10 million plus sales. Now, Rob and I were discussing last week on whether that was top of the market 2020 for super prime, and we sort of came to the sort of conclusion that pricing we anticipated would remain fairly constant, but in terms of the transaction volumes, this may fall away slightly. And obviously, we've got from this month, April 2021, we've got the 2% additional surcharge for those foreign national buyers, and what impact that might have on the market. I don't know if you've got any thoughts on that.
I mean, I think that it's. When we're talking about stamp duty, it is easy to forget that the additional 2% snuck in as well. So I think that there may well have been some overseas buys. I think what's been interesting is that over the last 12 months, because of various travel restrictions both here and abroad, a lot of overseas buyers who would have come over to London to shop for a new property haven't been able to do so. I mean, some of those have bought at arm's length, but I'd say the majority have held off. And so I think the question about whether, in terms of activity, will that market, is that market sort of topping out at the moment, will really rely on sort of when those buyers can come back to the market. Because I mean, I think what's even more astounding about the level of activity in the super prime market is that that's been happening when a big chunk of their traditional buyers haven't been able to access the market. So, you do wonder what would have happened if those overseas buyers could have come in as well. We would have had a really bumpy year in terms of activity. So, I think that from a domestic buyer point of view, I think that, there's only a finite number of people who are shopping at that kind of level. And so, and quite a few of them seem to have bought within the last few months. But I think if overseas buyers can come back, then potentially we could see a real surge in activity. It's about, at the moment, it's about when that's going to be.
Yeah.
And Marcus, on that point alone, last week's show, we discussed the announcement, however official or unofficial it is, of London having the most transactions in super prime in 2020, knocking whether it's New York or Paris or Hong Kong, Singapore off their perches. And I just think, in line with what you've just said, if that was the case, and that statement is relatively true, and we all know the restrictions from the super prime, ultra high net worth buyers, which are and historically have been, I would say, 80% foreign nationals within that space. We can only, with excitement, wait and see what opportunities that market brings when such travel restrictions are dropped and the market opens up even more. I think the anticipation and excitement for that within the industry is something that we're all looking to see, because to perform so well with one hand tied behind your back and to create those results in a pandemic year is just phenomenal.
I completely agree. And, I think there's a lot of themes that come out of this that potentially benefit that super prime market. I mean, a lot of people coming into the UK previously, if they were coming over here for a month or something over the summer, they'd take a whole floor of a hotel. Will people be keener, post sort of pandemics, to have their own space where they know everyone who's been within that space, they can all be COVID tested? Actually the demand for having your own property rather than renting hotel suites could potentially be more in demand. So I think there's a lot of sort of interesting new things that come out of this, and many of which I think could potentially benefit that super prime market.
Yeah, and just in terms of, like I mentioned, the 2% surcharge for the foreign overseas buyers, in addition to those other stamp duty charges, and I'd anticipate that affecting the market, the prime market, up to about 4 to 5 million. And those trophy assets up in excess of that, I think, will continue to trade. As their names say, they are trophy assets. They're complete one-offs. There's the rarity factor, so that could enable the super prime market in London to continue on the back of its momentum from 2020, where we saw the record broken at the start of the year for the most expensive property in London, here in Rutland Gate, and there has been some more talk of how many £100 million plus properties there are here in London.
Yeah, I mean, I think it's very, very difficult to quantify, because actually, by nature, a lot of these properties are owned by people who do not need to trade those properties. They probably have a portfolio of properties around the globe, and if they buy the best house on the best street in London for 150 million pounds, where do you go to from there? So actually, a lot of these people, they buy these properties and they hold on to them for sometimes generations. So, we could be looking at just really a handful or two of these sort of really top end sort of 150 million plus properties. But yeah, I mean, it's interesting, and I think you're completely right about the surcharge. I think that it probably does hit the sort of sub 5 million market. Although I think what's really interesting is that, obviously no one wants to pay additional taxation when they're buying a property. But all it needs, particularly for foreign buyers, is a little bit of a fluctuation in currency, and it wipes out any of those additional taxation. So if you look at the cost of prime central London in dollars compared with the peak in 2014, it's still around 30% cheaper in US dollars than it was in 2014, and probably in pounds we're talking about sort of a 15% fall. So all it needs is a bit of a fluctuation in currency, and actually any additional taxation sort of slightly disappears. So it's a lot about when you move money around as well as taxation. So I think that it could hit that sort of investor market at the lower end, but I think less so at that sort of that real sort of trophy property level.
On the back of that, Marcus, and I know it's the old adage, and it's something that we talk about the whole time, but when there's so much uncertainty and volatility within markets and economies and countries, and everyone reverts to the safe haven products of gold and bonds and London real estate, and although it's so easy to throw out there, it's quite difficult to actually go against that when it generally does perform so well at the height of market volatility and uncertainty.
Yeah, no, I completely agree, and as you say, it's sort of I sometimes take it off presentations that I'm doing, because that sort of safe haven status is a little bit of a sort of it comes across sometimes slightly a sort of marketing spiel for when you're talking about these things, but I think it's very true, that in times of economic uncertainty, and I think there's a lot of uncertainty globally at the moment. London has traditionally been a place where people like to invest their money. It's compared with the sort of the stock market, property in London is not particularly volatile. It's proven to be a good long-term investment. And when you come to London to do some shopping over the summer, you can stay in your house. It's you can't sleep in a bar of gold. It's sort of the way it is. So I think that it shouldn't be underestimated. The sort of the global view amongst high net worths on the a prime central London property as an asset. And I think it's easy to forget that sometimes.
Great, James. What else have we got today?
Well, I just wanted to bring you bring yourself news and obviously the viewers of the low deposit 95% mortgages, which we've been referring to since they were first announced in Q4 last year. Now, some of the high street banks have started to offer these 95% mortgages, with the scheme now enabling greater access to home ownerships for those low deposit often first-time buyers generally, which in turn could boost transaction volumes more on a national scale, I believe, rather than just focused on London. But obviously, it will supplement those Help to Buy scheme incentives and also the take-up of new build flats and new build houses across the UK. So I think this brings some more positivity. It opens up the market. It follows on from the government strategy of their sort of Generation Buy strap line, which they have been commentating on for the last 2 quarters. I think that brings positivity to the market, and I think that obviously the multipliers of that in the construction sectors and across those first-time buyer entry-level sectors will filter through to the remainder of the market. And obviously, as those pricing points shift, there is a rippling effect through some of those early price brackets. So that's some news there. I mean, I don't know. It's still sort of fairly hot off the press. It's going to take a bit of time to bed in for this for the sort of facilitation of these mortgages and the vetting process to move through the market, but again, some more positive sentiment in the UK property market, which is certainly welcomed at the moment.
Yeah, Marcus, what are you seeing on that product pricing and the?
Obviously, it's a sort of a sector of the market that for prime doesn't have a huge sort of direct impact. That the vast majority of people who are buying in prime London have significant deposits or buying cash. So it's more of a national product. But as we were talking about before, the the whole market needs to be functioning for the market to be successful. So it's, whilst those sort of low deposit mortgages might not necessarily have a huge impact in terms of activity and our sort of day-to-day business, in terms of the whole market, it is pretty important. I mean, I think that one sort of slight concern at the moment is that the rates, they're a 95% mortgage, but the government is kind of guaranteeing the next 15%, as far as I can tell. But the rates are still pretty high. So the rates for a sort of 95% mortgage with a 15% guarantee, I've seen some rates about sort of up about 4%, and so the rates are much better for an 80, a 20% down 80% LTV mortgage. So I don't know whether they'll have to be a little bit tinkering around that, but I think that what's good news is that the majority of people that have been moving over the last 12 months have been people with equity, second, third, fourth steppers, and those first-time buyers have struggled. And so I think anything that can help first-time buyers is a really good thing. I think we probably just have to keep an eye on the detail really and see how it pans out. But as you were saying, James, it's still pretty early days, so I think we're kind of settling in, and the lenders are settling into what kind of level they're going to set on these mortgages.
Great, James. Anything else?
Well, just in the wider property market, this week we saw that Leon, the food retailer, sold for £100 million. It's followed their expansion trend in the last 12 months, which has largely followed on from Greggs, moving into the sort of more smaller stores, moving into motorway service stations. So that's an exciting one. It's going to further continue their expansion across the UK.
Great. And to wrap up for this week, expectations for the next quarter and the rest of 2021, Marcus?
Yeah, I think that we're in for a busy second quarter. I think that as we talked before, the stamp duty extension is kind of guaranteed that we're going to see a busy second quarter. In terms of what's going to happen later in the year, I think that I imagine we'll see a little bit of a slowdown over the summer, as we normally do, particularly if the roadmap goes ahead as planned and people are actually allowed to go on holiday, even if it's the Cornish Riviera rather than the French Riviera. But I think that I'm relatively confident, and I think even if we have a slower second half to the year, the activity that we see in the first half will mean that we're up. In terms of prices, I can't see prices shooting up in central London. I think at the moment we've seen them be pretty steady, and I would imagine that we will end the year sort of possibly a couple of % higher than where we started. But I think at the moment it's less about prices and more about transactions and getting that recovery in transactions. And I just hope that we see the momentum that builds in the first half of this year continue. So I'm pretty confident, and I think that the fact that the market has been not particularly volatile and actually has been pretty resilient over what's been an absolutely exceptional year in a lot of ways is really encouraging for confidence going forward.
James, your views on that?
Yeah, I think the next quarter, Q2 2021, is going to be a key quarter. We're going to be coming off the back of the stamp duty holiday extension. That's going to further obviously boost the market. It's then a sort of stepped process, moving down to relief on the first £250,000 of property purchases, which runs to the end of September 2021. So the government has attempted for there not to be a complete fall off on the savings, to sort of gradually ease that off, which hopefully doesn't create any sort of long stops on any property transactions, but enables a smoother process into the quarter 3 of 2021. But as Marcus said, I'm personally expecting very steady and low property price growth for this year. But the main thing is that we continue with the transaction volumes and the market remains fully open.
Yeah, I concur with both your views and really concur with what Marcus said previously. I believe, and I've said this and continuously, repeatedly said this over the last 12 months, that this government really wants to support the economy through the property market, and it is showing that with the incentives and opportunities it's providing. And as long as the government supports property, real estate and investment, I think that the industry will have the opportunity to continue and remain robust for the foreseeable future, which is 2021. And on that basis, I'm looking forward to a positive year ahead with hopefully lots of good activity for everyone. Wonderful, great insight as always, James. Great to have you on the show again. Mark, it's always brilliant to hear the intel, data, information and thoughts from you and Lonres. Thank you to everyone for following us on all the platforms, on LinkedIn, on Instagram, Clubhouse, on YouTube. Everyone that wants any of the handouts that they didn't receive or weren't able to get for today's show, please contact me and we will send them everything. And outside of that, I look forward to seeing everyone same time, same place next Wednesday with hashtag askrobco every Wednesday, feeding you live intel, live data, and telling you what is happening on the ground within property and real estate and lending and finance as it happens. Thanks so much, Marcus. Thanks, James. Have a great week and speak to you soon.
Thank you. Great to see you both.
Thanks very much. Great.